Some news came out on the 10Q this morning, showing that Berkshire sold another 115 million shares of Apple during the last quarter. Apple remains Berkshire's largest holding, and that seems like a good place to start. Sherman Lam, a 27-year-old Class B shareholder from Malaysia, asked a question that fits perfectly. He said, "Last year, you mentioned Coca-Cola and American Express as Berkshire's two long-term partial ownership positions. You discussed the merits of these businesses in detail in your recent shareholder letter. But I noticed Apple wasn't included in that group. Have your or your investment team's views on Apple's business or its attractiveness as an investment changed since the initial purchase in 2016? My response is straightforward. While we have sold some shares, I would expect that by the end of the year, Apple will still likely be our largest common stock holding. Charlie and I have always approached marketable equities the same way we approach owning a whole business. When we own a Dairy Queen or any private business, we think of it as a business. Similarly, when we own Coca-Cola, American Express, or Apple, we view them as operating businesses. Of course, there are differences, tax implications, management responsibilities, and other factors, but fundamentally, we assess every stock as a business. We don't try to predict market moves or time the market. Early in my life, I was fascinated by stocks and read endlessly, yet I often focused on the wrong things. It wasn't until I read The Intelligent Investor by Benjamin Graham that something clicked. There were a few sentences in that book that explained far more eloquently than I ever could. Treat stocks as businesses and let the market serve you rather than try to teach you. That perspective has guided me ever since. Charlie then helped me refine this approach even further. That's essentially why we own American Express, a great business, Coca-Cola, another great business, and Apple, an exceptional business. Unless something extraordinary happens, these three will remain central holdings even when Greg eventually takes over. The strategy is simple, almost deceptively so. In investing, unlike in fields like math or physics, you don't need to overcomplicate things. The key is having the right mindset. At present, building our cash position doesn't bother me at all. Given what's available in equity markets and the current global economic composition, holding cash alongside our investments seems attractive. One thing that may surprise people, we don't obsess over avoiding taxes the way many expect. At Berkshire, we are comfortable paying our federal taxes. For instance, on gains from Apple, we pay the current federal rate of 21%. Not long ago, that rate was 35%, and in the past, I've operated under a 52% rate. The government doesn't own our assets, but it does take a share of earnings, and that percentage can change any year. Given current fiscal policies, it's reasonable to expect some adjustments. Taxes could increase, and governments may decide to take a larger portion of income to address deficits or other priorities. Berkshire always expects to pay substantial federal income taxes because we believe it's right. The U.S. has been extraordinarily generous to our shareholders, and we feel a responsibility to contribute. For example, last year, we sent over $5 billion to the federal government. If 800 other companies had done the same, no individual in the U.S. would have had to pay federal income tax, Social Security, or estate taxes. Looking ahead, I hope Berkshire continues to maintain a high level of tax contribution, potentially even increasing it. Writing that check doesn't bother me in the slightest, and it should not concern shareholders either. Even with a 21% rate this year, or potentially higher later, the sale of some Apple shares should not raise concerns. Our approach to investing remains unchanged. Treat stocks as businesses, focus on the fundamentals, and let the long-term value guide decisions.